Welcome to the Chamber's 2022 Economic Outlook Forum this morning. My name is Simon Maji. I'm the Executive Secretary for the American Chamber of Commerce, and we're excited to have all of you here for this early morning session. We are indeed delighted that you could take time off this cold morning to join us for this early breakfast meeting. So we are very grateful for your time. It's an important topic for us today, looking at Ghana's economic outlook for the year. And it's important because this is a country that is seeking to spend about 137 billion Ghana cedis and has projected it can raise only 100 billion and would have to borrow an extra 37 billion from the market, with a projected GDP of 5.8%, with non-oil being about 5.9, and a fiscal deficit of 7.4, as stipulated in the budget. It's also a very complex meeting because we need to understand how government is going to raise the revenue, and that's mainly going to come from the private sector, businesses, individuals, to make up for that amount. And critically as well, the state is going through some debt sustainability issues. And so our panelists will address that as well for us today. They will address the issue of taxation, the issue of debt, the famous issue of the electronic levy, as well as looking at government's own economic outlook, economic policies for the year, the GDP, the monetary policy, where the growth is going to come from, and also the various sectors of the economy. To help us with this, I would hand over for the taxation part to our partners today, Pricewaterhouse. The other partner is also Joy Business. Abeku Jankwansa is a tax partner at Pricewaterhouse. He has over close to 2 decades of experience in advising companies on tax issues in this country. He's one of the most respected tax consultants and has been doing this for many companies across different sectors. His expertise relates not just to taxation, but also helping international businesses navigate the investment and trade environment in this country. He has been a speaker for this forum for the last 2 sessions. And so, ladies and gentlemen, without much ado, if I may yield to the tax partner at Pricewaterhouse to begin this session with the tax component of the budget, touching on the e-levy as well. Over to you, Mr. Beku Jankwansa.
So thank you very much, Simon. Please confirm that you can hear me.
Yes, I can hear you.
Yes. All right. So I will be sharing my screen, and then in order to avoid bandwidth issue, I may go off video after sharing my screen.
Thank you.
Okay, so good morning, everyone. And to start, I would like to say thank you to AmCham for inviting me to focus on the tax side of your topic, considering Ghana's economic outlook for 2020, whilst ensuring that at the end of the day, would have clearly considered the practical implications of the 2020 budget. So much as we will be looking at the economic outlook, I say every year that if you choose to invite a tax partner to speak on economic outlook, then please recognize the fact that we would be biased towards tax matters. The other speaker, who was one of my lecturers years ago at the Econs department, would focus on the other economic matters. So I hope he makes it a bit lighter for you to now broaden beyond tax and look at other areas. So to guide our conversation for today, Simon actually started making my work easy by recapping some of the key assumptions underlying the 2022 budget. But I will repeat some of it and then tie it to the conversation that we're going to have on tax. So by way of content, I would be looking at tax performance and outlook. I will then dwell into the tax measures for 2022 that were pronounced in the budget. But I guess if you have followed keenly the conversation surrounding the e-levy, you would appreciate that when it comes to certain tax matters that require specific legislation from Parliament, then the mere fact that it is in the 2022 budget doesn't mean much. It only means this is what the executive government seeks to do. Does the legislative government support it? So that support needs to come before some of those measures can be implemented. And that is why there are certain things in the 2022 budget. Those things need to go through Parliament and get approval for us to be able to implement it. So I'll be looking at the tax measures in 2022, and then I would share with you those ones that have been passed and the implications, obviously, on our businesses. And then lastly, Jesus that we all followed when he was leaving this world, he gave us some concluding remarks. So if I'm his disciple, then I need to also leave with you some concluding remarks from this conversation. So to start, someone did mention that in terms of expenditure and arrears for 2022, we are planning to spend 137.5 billion. A couple of weeks ago, when the Ministry of Information did their media press, and it was a time for the finance minister to have his turn, he did indicate that if you don't give me the chance to get this e-levy through, I may have to reconsider some of these numbers, at least for the first quarter of this year. Which clearly means that as a people, if we plan to spend about 138 billion, we need to recognize that that 138 billion would have to be financed. The interesting thing is that this 138 billion, if you work, I work, and we all work, and in aggregate, we generate income. We are saying that as a people, we would be spending about 28% of the income that we've collectively earned for our common expenditure. This is increasing a bit from the planned 25, and when it was about 112 billion. So as compared to last year, if we perform as planned, then we are saying that we are increasing our expenditure and arrears envelope by close to a quarter of what we did last year. For government to have authorization to spend, an appropriation bill would have to be passed by Parliament and agreed to by the president before they can spend. So if you hear a conversation going around that, oh, we've passed the budget or we've passed the appropriation bill, how do we finance it? Then this clearly means that the appropriation bill, which becomes an act, ought to be financed. So how do we intend to finance this? We would be running a deficit, taking loans to the tune of about 37 billion to be able to finance our common expenditure of the 137 plus billion. So one would ask, where is the rest going to come from? The rest obviously is going to come from income that we generate together as a people. So for 2022, the plan is that we would collectively spend 138 billion. About 37 of that would be financed from debt. This is a reduction in planned deficit of about 41 billion from last year. So we're actually seeking to drop our financing of the budget by way of loans by about 10%. In 2018, we as a people said to ourselves that would ensure that our deficit does not go beyond 5% of the income that we collectively earn. But we can see that this 7.4 exceeds 5%. And so what that means is that we are going beyond that. And we did give certain reasons during the onslaught of COVID to say that we cannot comply with the 5%. So that is why we are planning to do 7.4. Government hopes that by 2023-2024, we should be back to the 5% and fully comply with the Fiscal Responsibility Act that we passed for ourselves in 2018. As regards financing that expenditure from revenues and grants of 100 billion, we are moving from a planned 70.3 to 100 billion. So we are seeking to grow our revenue envelope by about 42%. Now, this should begin raising some questions in our minds that how do we intend to have a year-on-year growth of 42%? What is it that government is going to do to be able to achieve such a leap? And as a people, are we ready for such a leap? So last year, if everything goes as planned, when we get the final numbers, we hope that we're going to do about 16% to GDP as regards revenue and grants. So this is not what do you call it? This is not tax to GDP. This is actually revenue and grants to GDP. 16.0% of GDP, which is 42% from what we did last year. So what are going to be the constituent parts of these? We expect 20.3 billion to come from other revenue sources. And by other revenue sources, I mean non-tax revenue sources. And my non-tax is wide enough to include grants. So we expect that out of the 20% to GDP, in other words, all the income that we earn, 20% of it is what we would internally raise. We are saying that 4% of that will come from non-tax revenues. So this therefore means that in terms of tax revenues, we are planning to raise 16% of our income in tax revenue. So by the end of 2020, when you work, when you run a business and that business earns income, when you put things in investment, you earn income. All of us generate income. That we are saying that cumulatively, 16% of the income that we generate together, and this is an average figure. So some of you may pay taxes up to 30% of your income, but somebody may pay 5, others will pay 0. So on aggregate, we are saying that together of the income that we generate, we would put aside 16% for tax purposes. Now, how have we performed as a country? Or how did we perform as a country in 2021? That would give us a reasonable idea of where we're coming from. So a couple of weeks ago, I should think last week, the revenue published that they had exceeded their target of 57.0 billion. So they actually raised 57.3 billion. So according to the revenue, out of that target of 57, they raised 57.3. Government has now given a budget of 80.2. And you may know that I'm using different words, budget targets. Because when you look at the budget numbers that were disclosed for 2021, what the budget shows is a net tax collection of 55.8. But of course, as we sometimes do in businesses, you have your budget and then you have your target to pull you a bit up to achieve the things that you have set for yourself. So we are going to move from about 57.3, hopefully it is net tax revenue, to 80.2, a 40% leap. The question is, you and I would have to contribute our quotas to be able to get this 40% leap. So as I said, GRA last week or so came out to say, this is it, we exceeded. And this week, if you check the daily graphic and the BNFT, you would see that GRA has actually issued a thank you note. I would say largely the recent GRA, give or take, of course, we may not be happy with everything, but give or take, they are trying to develop a more corporate-like behavior. So they came out to say thank you. But in their thank you notes, one of the points of interest was to indicate that those in the extractive sectors, those in the telecom sectors, for example, should note and discharge their liabilities quickly. So if you are within those sectors, then what this means is that please take note and ensure full and proper compliance, as the revenue may be looking your way. Now, if the revenue says that I would be increasing tax by 40%, then the first point to check is that to what extent will the economy itself grow? So let's go and see. In 2022, ignoring the effect of inflation, the economy will be growing a little bit below 6%. So if the economy will be growing a little bit below 6% and government says that I intend to grow revenues, tax revenues by close to 40%, then that should send us some signal. In other words, if the growth in tax revenue would be exceeding the growth or the average growth of the economy, even when adjusted for inflation, which we are planning for about 8%, it is still going to be below 7% growth. So even if the economy grows in nominal terms by about 7%, but tax revenues should grow by about 40%, then what this should signal to you is that compliance would be key on the agenda. So get closer to your accountants, get closer to your tax consultants, get closer to your lawyers to help you as much as possible comply. Having shared this, Simon mentioned at the beginning that, and I've also mentioned that we're going to run a deficit of 7.4. But when we pick that and exclude non-interest related expenditure, we would actually have a balance of 0.1, which is positive. And our import cover would be low or just below 4 months for 2022. And just looking into the crystal ball, our primary balance on average by the end of 2025 should be 0, which would then be in line with the Fiscal Responsibility Act. And hopefully by 2024, our fiscal deficit should be below 5. So I've talked about how tax fits into the equation, compared it to the underlying assumptions in 2022. So now let's go on and see what is going to happen on domestic revenue generation. So for those of you who have read the PwC budget digest for 2022, you probably would have seen the image that I have at the top right of these slides. Otherwise, you can just download it and read it. So out of the 100 billion, we are expecting that domestically, we should be able to raise about 99.6. Effectively, this tells you that the 100 billion will mainly be from domestic revenue generation. So what this means to us is that since we became a middle income country, whether lower or even at that classification, we need to generate our income domestically. We've talked about several sources, and if you recall, government says that for fees and charges, for 2022, there will be an uplift of 15%, and then subsequently, there would be an adjustment in line with inflation so that the fees and charges reflect growth in the economy and also translates and accommodates general increase in prices by way of inflation. So I'll come back to talk about that a little bit more going forward. But then where I'm going to focus my attention is on tax. So you remember the 80.2 I talked about. And I also mentioned a net revenue budget of 55. So hopefully we should be growing by about 45, different from the 40 I talked about, because I told you that that 57 was a target. From income and property taxes, we are expecting to raise about 38 billion. So your company income tax, your PAYE, our self-employed friends, amongst others, would raise 38 billion, which is a 33% growth over what was planned for 2021. In terms of indirect taxes, and you will see that when you look at the balance of direct and indirect taxes, we would be raising about 54% of tax envelope from indirect taxes. And of course, for me, this is not problematic because this aligns closer to the structure of our economy, which is largely informal. So it may be difficult to get those in those sectors to file their income tax and stuff for you to rely a lot more on direct taxes. So you need to design your policies to align with the structure of your economy. Now you would see that on domestic supplies, we are going to raise an extra 60% from that. Whilst from custom-related taxes, we would be doing an extra 34. What this means to us is that where is this 60% going to come from? Why are we increasing tax in domestic supplies by close to 14 billion? Part of those 14 billion is where the e-levy, which is about 7 billion, is sitting. So if you can understand why government, despite the public pushback, keeps talking about e-levy, it is because that accounts for about 7 billion or about 50% of the increment in domestic taxes, excluding income. And so if that 7 billion doesn't come in, then the 22 to 36 would not be achieved. So having set this background for us to appreciate how our contribution to the budget occurs, we can now go on to look at the tax measures and the practical implications on our businesses. So to begin, I think it's instructive for us to look at an extract from the 2022 budget. And this was read by the Finance Minister, Mr. Ken Letoforiata. He says in paragraph 321, Mr. Speaker, to sum up, government wishes to reiterate that we are in challenging times, which require radical measures. So let us all embrace these new policies to enable government address the fundamental issues affecting the economy, to ensure that our nation continues to maintain its position as the black star of the continent. So this was a plea, in a way, from the executive to our legislative arm, acknowledging that we are not in times that are good enough. There are issues. And therefore, some radical measures are needed. So what are we going to do on the back of these? What are the measures that were proposed? So to go through, first, some of these measures that I'm going to talk about to help us leap from 57.3 to 80.2 would involve a number of things. According to the GRA, even though my checks at the Assembly Press about 2-3 days ago shows that they don't still have copies of the laws. And I'm still wondering why, close to 65 years after independence, we cannot get these things on the internet, because I can sit here and get whatever law I'm looking for from our colonial masters sitting right here in Ghana. So why must we always finish this, send it to the Assembly Press before we all go and choose Assembly Press for copies? Truth of the matter is, yes, our constitution is clear that unless a law that is passed provides for a separate or a special date for implementation, as soon as the law is passed, from the midnight of that day, in other words, from the morning of the next day, the law comes into effect. So if it is passed and it is gazetted, look at the gazette date, and that should give you an idea of when the law comes into effect. But the truth of the matter is, I'm aware of cases that have gone to court where people have gone to use laws that are not the Assembly Press version, because Assembly Press is the official printer of government. They've used those and they have actually lost their cases. And some of them now are not happy. And they are seeking certain alternative reliefs right at the level of the Supreme Court. So should we be wasting the time of our Supreme Court on some of these matters that we can easily put on the internet and know which laws have been passed? So according to the GRA, the laws that I'm going to talk about are now in force from 1st January 2022. So I would encourage you, get support and transition as soon as possible. So the practical implications of the 2022 budget, what are the things that we're going to talk about? The first two things we're going to talk about are changes that have occurred in respect of dealings with small-scale miners and small sole proprietors. The laws supporting these policy proposals have been passed, and they've been passed in a law known as Act 1027. It's an Income Tax Amendment Act, Act 1071, sorry. It says that when you are now dealing with a small-scale miner, and typically these are individual Ghanaian citizens, when you buy unprocessed minerals, typically gold, from them, previously you had to withhold 3%. Now you have to withhold 1.5. What does this mean to our operations? A number of times, people in the informal sector think about tax as cost that the other party must pay. So if you tell him that I'm going to withhold tax, he then grosses up and says, then this is your cost, so that they can get their net. So the previous effect where you had to be grossing up by 3, now there will be some relief to you by grossing up 1.5. If you are a small scale miner, what that essentially also mean is that if you were not into the grossing up business, then what this means is that now you can, a little withholding will be done on you as compared to the previous 3%. This does not apply to the large scale companies. So please take notes. The likes of the Goldfields, the Anglo Gold and Co, when they sell and they sell domestically and you are withholding from them, of course, a lot of their gold will be shipped out, but just in case they sell locally and you want to buy, this is not going to be your withholding tax. So please take note. This is for small scale miners. The second thing, which may not apply to a number of you, unless you do some businesses as small sole proprietors. In other words, your business is not being run under a corporate structure, but you are just running it as an individual who has not incorporated that business, then what the law is now saying is that you can apply what is called a modified taxation approach to determine your income tax. So to explain that, under our tax laws, typically what you do is to determine your income based on profits. So you compare how much you sell, how much you expended, you take the difference and you apply your tax rate. So that's the default. Then there are ones that when the person withhold on you, that is the final amount of tax that you pay. And then there is also the bit on what we call modified taxation. But the modified taxation applies to a special class of persons who are typically running their business as sole proprietors, small businesses. So previously, the cap to do that was that your annual income or sales should not exceed 200,000, typically. Now, government has increased that to 500,000. So if your income does not exceed 500,000, you could potentially pay tax at 3% of your revenues, whilst others will pay probably at 25% of their profits. There are other peculiarities in there, but I wouldn't bore you because a lot of you may not be in that sector. There were some concessions that were issued in respect of COVID-19. So some of you would have heard it for the trotro guys, for example, and then those that paid tax stamps. Government has increased that to June this year, or extended it to June this year. For those of you who were into education, private education, hotels, tourism, the 30% rebate that was given to you ended in December last year. So even though they were given with these small scale people, theirs have been extended, but yours was not extended. Probably government's view is that the hotel businesses are back, tourism is fine. But maybe to compensate for all these rising issues around petrol, for the trotro guys and the small scales, they have been extended to June this year in terms of rebates. So if you have a trotro business and you are paying VIT, and your driver calls you that the policeman has stopped him because he doesn't have a VIT sticker, please note that certain questions has to be asked of that trotro driver because it's been extended to June. The next thing that we need to talk about is that government has increased and introduced what we are talking about by way of small VAT registered retailers, or what you call the flat rates. What government is saying is that previously, if you were a large supermarket, and not to give any particular supermarkets some advantage over the others, I'll mention as a lot as I can for the sake of illustration. So it could be the ShopRite, the Games, the Malcolms, or any other shopping outfits, the CTDS of this country. You were previously charging VAT at 3%, and when the COVID-19 came, you added that 1%. Now, government is saying that I am going back on this bad flat rate scheme and reserving it for those whose revenues do not exceed 500,000, or to be more precise, lies between 200,000 to 500,000. So if you earn more than 500,000 in sales, then you are no longer a flat rate operator. So from 1st January this year, you should be charging VAT at the standard rate of 12.5 plus the allied levies, which adds up to 6. But if you go with the GRA cap, then effectively you will be paying 19.25 on that. So please take notes and update your system as soon as possible, because the revenue says that the effective date for this implementation is going to be 1st of January 2021, although their public notice came out in the 20th of January. Please take note and make the adjustment. If you are properly called a wholesaler, then irrespective of the fact that your revenues do not exceed 500,000, so long as it exceeds 200,000 and you are VAT registered, you should be charging VAT. So please take note of this. Amend your systems. If you don't have standard rate invoices, contact the GRA as soon as possible. Pick up those booklets and try to comply. Otherwise, as the law says, the liability for domestic supplies of taxable supplies is on the supplier, unless you can prove that the recipient actually deceived you to do otherwise, in which case the revenue may go after the recipient. The next thing that we need to note is that for local textile manufacturers, government says that I have seen that my 3-year policy that I gave to you to charge 0 rates on your local textiles, even though they may not have been exported, is yielding good results. And therefore, even though I'm going to lose about 195 million from this concession directly by way of revenue that I could have collected, I'm happy to extend it by 2 more years to 31st December 2023. So if you are the likes of the textiles, ATLs, and the rest, or you may even be in your small corner somewhere, if you have the Minister of Trade and Industry give approval to your operations expressly, then whilst others are selling and charging effectively 19.25, you would be charging 0. And hopefully that makes yours cheaper, and that should boost what you do. Moving on, for those who are personal individuals, employees, even though it was not expressly stated in the budget, government has revised the tax bands effective the start of this month. But unlike the problematic case the VAT one would cause, we typically pay salaries at the end of the month, or from the 25th, or from the 23rd. So hopefully you would have seen the GRA notice that is effective and have applied it. The implication of this is that even if you don't increase salaries, we expect that the net take home of your employees, all else equal, should rise by up to 15 cedis per month. So just before you say the 15 cedis is too small, please multiply by the number of people who would have these 15 cedis, and then we can see the effects. According to government, we would be losing directly about 220 million cedis for 2022 as a result of this measure. Closely linked to this is for us to appreciate that 2 things. 1, government did this to ensure that the minimum national daily wage is not subject to income tax. But personally, I've had a concern of why we need to keep going back every year to do the amendment of the table on account of this. Life could have been made easier by just stating in our section 7 that the daily minimum wage is exempt. When we do that, that saves us from having to spend time at the ministry checking these numbers, fixing bands, taking the Attorney General's time in drafting, taking the time of our parliamentarians to debate tax tables, and we can commit our scarce time resources to other more productive ventures. So personally, I find it problematic that each year we just go and sit down after this table has been, after the minimum wage has been adjusted, when we can just put a single sentence, like what we have for cocoa farmers, the income of a cocoa farmer is exempt. We can just put in the minimum wage is exempt, period. And then when there is necessary, or it is necessary for us, to amend the bands, then we amend the bands. Closely linked to that is the issue of government saying that if you're a high net worth individual, in other words, if God has blessed you or you are working hard to generate good income, we already have a dedicated unit to make sure that you get premium services and invitations from the revenue. Government is saying that they are concluding some policies to make sure that if you're a high net worth individual, you are properly taken care of, and that is done properly in terms of tax compliance. The other thing that we need to note, even though it was not in the budget, is the issue of what I call PUA 2. So the PUA is the Penalty and Interest Waiver Act. It was introduced in 2021. Government said that about 741 people applied for it. The GRA granted waivers of about 436 million. But government is saying that when they went to Parliament, they wanted to extend it to March. Parliament was good enough, so you can call your parliamentarians and thank them to extend the March to June of this year. So if you have penalties and interests potentially with the GRA, and they are in respect of liabilities up to 2020 December, if you consent to that liability and you write to GRA, GRA would waive it. And you must get a waiver certificate evidencing that it's been done. And the moment you get that, GRA cannot come back to you in future to initiate prosecutions or any other enforcement action, and they cannot come back to collect the interest and penalties from you. This is a very good measure. I would encourage you to make commercial decisions, speak to your consultants, align, and see which portion of taxes in dispute you may want to settle, as we keep waiting and praying that the Independent Tax Appeals Board, which law was passed in October 2020, would see the light of day. Then there's the issue of the benchmark discount policy. Personally, I feel that this merry-go-round that we are doing is not helpful. According to EMT, led by the vice president, there was a problem. And the problem led to the discount that was granted. The fundamental question I have is that, has the problem with the database been fixed? Because I don't think EMT just sat down, and it would be painful if they did, and just tell us 50% with no basis, 30% on vehicles with no basis. So hopefully there was basis to the reduction, and I heard the vice president himself say that there was basis and studies that were done. If indeed those studies were done, and I don't have reason to doubt that the studies were done, then I don't think that just reversing solves any problem. What we need to do is to check whether that benchmark reference point have been fixed. And closely tied to that is, according to GUTA, they claim that GRA or Customs Division just use benchmark even without any reference to their invoice values. If that is really true, then that is a flat disrespect of our laws, because our laws are clear that you start from transaction prices. Having said that, I believe that the database should be looked at and fixed. Lastly, or just before lastly, the issue of tax exemptions. The tax exemptions bill is currently in Parliament, and the electronic payments is what I would end with, so that I can hand over to Prof to talk about the wider things that we need to be looking at. So I will skip the exemptions bill for the sake of time and jump to the electronic transfer levy bill. So we all know that this is a 1.75 levy that applies at the time you make an electronic transfer, when your dealings involve these entities or these persons that I have listed. So if you are doing something involving electronic money issuers, so simply said, Airtel money, Vodafone cash, MTN mobile money, then you are getting yourself into the framework and scope of the e-levy. If you deal with payment service providers, like the blue engines of this world, you are getting into that scope. If you deal with banks, you are getting into that scope. If you deal with specialized deposit-taking institutions, you are getting into that scope. And then finally, if the minister says that I want to expand on this class and he does it, and you deal with them, you are within that scope. Which transactions are covered? When you do mobile money transfers to another mobile money transfers, you are covered. And this is based on the bill which the Finance Committee has approved. So unless the debates at the plenary leads to a change, this is what we'll sit with. If you transfer from a bank account to mobile money, it applies. When you do the reverse, mobile money to bank account, it applies. When you do a bank transfer, the only time it applies is if it is originating from the bank account of an individual. So it would mean that the bank should note whether it is an individual account or it is not an individual account. Will account of, say, partnerships be considered as an account of an individual? What if those partnerships are, of course, for running business? Would that qualify? How would the bank distinguish that from joint accounts held by married couples? These are things that we need to have answered, and hopefully, as the bill develops, because I hold the view that the issue at this stage of throwing it out may not be there because of certain acts that have already been carried out by our parliamentarians. And I believe it's just more of engagement to see where the balance would lie. So these are the covered transactions. Within these covered transactions, there are some exceptions. And what are they? If you transfer up to 100 cedis per day by the same person, so the natural question is, how would they know that it is my SIM from Airtel and I'm the same owner on the Vodafone side? So we know the push from the Ministry of Communication on re-registering. So until that is done, I'm not too sure how this exemption on cross-network would work. So maybe to start, to give us some relief, government may introduce something that I don't know. Would it be an increase in the threshold until the time when we have the linkages done? Otherwise, I'm not too sure that the telecom operators, and having spoken to some of my friends that work there, have a common platform for cross-identification. 2, transfers owned by the same person. So I have an account in Barclays. I have a mobile money account. Bank of Ghana have issued a notice that by June, we should have notified our banks. Otherwise, from July, the Ghana card is going to be the only way of transactions. I had a bit of problem with the issuance because there are persons in this country that do not qualify for the Ghana card. And I think the revenue has done well. GRA, maybe after we having a number of fights with them, in their notice extending the period for 10, have provided exemptions for those that cannot get the Ghana card. So hopefully the BOG would look at this. This is a first statement. We do appreciate it. There could be amendments to it so that they are not trouble that are caused because the NI itself have had issues. Then if you pay taxes, fees, charge on the GGov, and as you know, that's where we all need to pay our taxes now, even though it's an electronic transfer, and I personally have an issue with the incidents being on the transferor. I thought it would have been better to be on the transferee because the liability for paying income tax and even for VAT is on the recipient and not on the payer. But government probably have their reasons. I wish it was published so that we could all critique and read those reasons. Specified merchant payments. Personally, I'm glad this has come in because in the first set of the bill, it was not there. We proposed it as PwC in our documents and in our public forum. Government hopefully might have listened to us or listened to somebody else and included specified merchant payments. So if the person is registered for VAT and income tax, you, the payer, would not have to pay the e-levy. And then lastly, transfers between mobile money principals, mobile money agents, and master agent accounts would also not be in there. So I would end so that I can hand over to Prof. by saying, as usual, we believe that all these things hangs on timely implementation. E-levy is already suffering from timely implementation because the plan was to start implementation from 1st February. And it is this 1st February where we are now going to start debating it again in plenary. So thank you very much for listening to me. If you need further information, you can download this document, 2021 tax facts and figures, the budget digest, and our curriculum from the business school, and then we can engage a bit more. So I appreciate your time. And for those of you who didn't join early and see who is speaking, I'm not a ghost, don't worry. I just remain your cheerleader. If you need any support, please feel free to reach out to me and I'll gladly help you comply in the most optimal way. So Simon, hand over to you.
Thank you. Thank you, Abeku, for that excellent presentation. We remain grateful to you as always. So we'll jump in straight. I hope you'll stay around a bit for the Q&A session. It'll be very brief and straight to the point. Our next speaker is Professor Eric Osesibe. He's an associate professor at the Department of Economics and Dean of International Programs at the University of Ghana, Ghana's premier university. He is currently a board member of the BOG, which is the Bank of Ghana. He will speak to us on the micro and macro targets of the budget for 2022. That's looking at inflation, interest rate, exchange rate, and also the anchor growth areas of the economy. Ladies and gentlemen, please, I yield to our next speaker, Professor Eric Osesibe. Professor, over to you, sir.
Thank you. Many thanks, Simon, and good morning to your members, your cherished members.
Good morning.
So if you would extend to me the hosts, I will be glad. So kindly, I think there is an issue. There are two of my links showing. The other one has the hosts, but the one that I have the presentation on does not have. So the one with my picture, if you can extend it to that. It looks like
just a minute. Just a minute. Just a minute.
All right. Great. Okay. All right. Good morning to you once again. And thank you for having me to make a presentation on the economy and how we perceive the outlook of the economy to look like over the next couple of years. So by way of context, my presentation, we're going to go briefly at the global context, what is happening in the global world. And then we'll look at the real sector of the economy, the GDP growth projections, and then we come to the demand-driven policies, monetary development, external development, and then fiscal development. Under the fiscal development, we also look at debt sustainability issues and key macroeconomic outlook. And then we look into the future, looking at the upside and downside risk to the growth and macroeconomic projections that have been made. You are free to ask me any question in the course of my presentations. If you have any burning issue, please feel free so that it can also be as interactive as possible. Okay, so looking at the global economy, the global economy entered 2022 in a weaker position than was actually expected. Before the year, growth was projected to be around 6%, but given what was happening, especially with the emergence of the new Omicron COVID-19, the IMF and a key development agent decided to downgrade or play growth down by reducing growth to from 6 to 5.9. The key drivers of that was the supply chain bottlenecks that don't seem to go away, elevated inflation, and then energy price hikes that really caused a slowdown of growth, and especially also wage hikes and labor markets problems that is occurring in many advanced countries like the US. Most of these issues also fueled broad-based inflation. So we've seen across the globe inflation picking up, largely informing monetary policy tightening across most of the central banks. So inflation has been high, rising in US. In fact, US it has reached about 3 decades high, at around 7% yesterday. And many emerging countries are experiencing high inflation. Underpinning that inflation cost is the crude oil prices that have been trending upward, doubling by about 50% over the course of last year. And then also we have global oil inventory issues that also underlying the crude oil price increase. So crude oil currently hovers around 70 to 75, and in some cases 80. So it oscillates between 70 and 80 over the last couple of months. The outlook is that it may stabilize around 70 per barrel in the half year or the third year. It may come around that point. So that is within the global context. Macroeconomic variability, crude oil, energy price increase, supply chain problems, and inflation going up. So if you look at global growth projection, you realize that last year growth is expected to be around 5.9. That's the world output growth. For this year, 2022, growth is projected to be 4.4%. And onward growth is to reduce to about 3.8%. The highest growth is expected in India, which is around 9%, the fastest growing economy in the world, followed closely by China. In sub-Saharan Africa, growth is expected to be around 3.7 this year from 4.0. The key drivers of growth in sub-Saharan Africa, as you know, is Nigeria and South Africa. And they are also recording very positive growth from a contraction in 2020. We've seen some hikes in growth in Nigeria, which is expected to be 2.7. And then South Africa, 4.6 last year, expected to be 4.6, but declined to 1.9 this year. So that's global growth projections. Now let's come back home. We know that November 17, the Finance Minister, Mr. Ken Ofori-Atta, presented the Ghana budget, and the budget was themed building a sustainable entrepreneurial nation, fiscal consolidation, and job creation. So drilling down on this theme, one will find that the key issues or economic challenges that the budget is seeking to address are three things. That is, these are the high youth unemployment, the teeming youth that are currently unemployed, which is around about 13% by Ghana Statistical Service data. And then the large fiscal deficits, rising debts, that really presents some downside risk to macroeconomic stability. So the budget is seeking to close this fiscal deficit and also bring debts to a sustainable level. And thirdly, is to close the infrastructure gap. As you know, we have huge infrastructure gap. Our road network, we're talking about hospital facilities, energy infrastructure, and a host of other infrastructure that Ghana still lacks. So this budget is seeking to do this, and whether this will be possible is another question that we all will seek to answer. So let's move to the real sector of the economy. So growth, I show Mr. Abe referred to the growth projection. Growth for this year was projected to be 4.4 from a low of 0.4. But given the third quarter growth of about 6.6, the outlook looked more positive than that. So growth projection is now expected to be higher than what was targeted. The target growth was 4.4. We are actually targeting now growth to go a little higher to about 4.7. This growth for this year, growth is expected to be around 5.8, but will average around 5.5. And there on, it's going to plateau. Now, the key drivers of growth was actually the increase in industry, largely driven by crude oil production, which is expected to increase from 160,000 per barrel last year to 190,000 per barrel this year. From there on, it is expected to be flat, and that could limit really our growth projections if we are not able to grow heavily on our non-oil real GDP growth. Growth from crude oil will be flat. And so growth from 23 going has to be driven largely by non-oil, from manufacturing, from agriculture, construction, and the likes. So in terms of sectoral growth, you could see that growth projection for 2022 is largely going to be underpinned by industry, as I mentioned, that is oil growth, leading to growth of about 6.3 in industry. Agriculture is also expected to grow by about 5.3%. That is incumbent on government's ability to continue with the planting for food and job. Otherwise, this 5.3 projection of growth will be difficult to achieve. Service sector, which has been over the long period of time, has been the main driver of growth, will be averaging 5.6 in the year 2022. So the growth, as we've seen, will be underpinned largely by significant increase in private consumption, private investments, investments in exports or export growth will significantly underpin growth. That the growth in oil exports, cocoa exports, and timber exports, and gold exports will be key for our ability to achieve the growth projections that have been done. Service exports will also play a key role, and that will mean that a gradual recovery in the tourism sector will remain crucial for the growth projection. There's, however, downside risk to this growth, especially if we see some slowdown in major trading partners, key trading partners like the US, Europe, and then East Asian Pacific. The threat is heightened with the spread of the COVID and then the reimposition of some travel restrictions that could have some significant negative impact on our growth projection if the situation is not reversed as soon as possible. On the monetary and financial sector front, looking first at interest rates, the treasury bill rates over the last 4-5 years have been stable. We've seen, although a lowering of the treasury bill rates, but on the whole, it has been quite stable. As you can see, 91-day treasury bill from 2017, 13% reduced marginally to about 12.49 by 2021, and then 180 in the same manner. Where we have seen a marked reduction has been on commercial bank lending. Commercial bank lending has trended downwards from 28.97 in 2017 to an annual average of about 20% by 2021. And so that appears to be now responding to the monetary policy rates somewhat. And so we've seen some reduction in the interest rates, in the lending rate. But this reduction in lending rates, data show that it has not translated into private sector credits. Private sector credit, growth in private sector credit has been sluggish in both nominal and real terms. If you compare growth pre-COVID era, where growth was around 19%, and around 2017, 2018 was in the 30%. And now, last year, growth in the private sector fell to 10.3%, compared to even COVID year 2020, which grew by 13.4%. In real terms, growth has actually been negative, growth by about 0.78%, compared to a growth of 3.02% in the year 2020. So that is a concern because access to credit remain key to our ability to expand the economy. I mean, for private sector to be able to get access to credit and invest in capital and expand their output would definitely be important, especially as we expect crude oil production in the next 2 years to be flat. Growth will likely be driven by the non-oil growth, that is manufacturing and other services sector. And the other factor that also explains the sluggish growth in private sector, growth in credit to private sector has also been the credit quality or asset quality of the the deposit money banks, that is the commercial banks. Their increase in the non-performing loans mean that banks are being careful. They don't want to add to their already bad assets, and so they are pushing the funds to government securities other than advancing money to the private sector. And that also has an implication for our growth, because that, as we say in economics, the crowding out. The private sector is increasingly being crowded out, largely because of the systemic risk in the system, the perception of risk in the system, and the fact that the banks are trying to protect their capital and solidify their balance sheets. And so they don't intend to expand too much credit to the private sector. And that remains a concern to the economic management. So let's look at inflation. Inflation is one of the most important macroeconomic indicators because it affects almost everything. It affects investments, household consumption, government expenditures, monetary policy, fiscal policy, and everything that you can think of. Now, over the last couple of years, government has done quite well by steering inflation towards the medium-term targets. Indeed, inflation in May 2021 fell below the lower band of the median band of 8 to 7.5. The medium target is between 6 and 10, and the mean or the median is 8. So in May 2021, inflation was 7.5. Now, for some reasons, inflation has started going up, rising from 7.5 to the last year December level of 12.6, going way ahead of the upper band of the medium-term target, the upper band, which is the 10%. Now it is about 2.6% basis point. I mean, higher than the upper limit. That, of course, provide limited room for monetary policy to continue to reduce, or from the central bank to continue to reduce the monetary policy. Now, what are the underlying factors for this inflation uptick? One is the global inflation, which is above target in many advanced and emerging countries. So largely, we are also experiencing imported inflation. As long as we continue to import significant portion of consumable goods, it means that if there's inflation in US, we will import that inflation to Ghana. So one of it is imported inflation. The other is petroleum price adjustment. As you can all witness, we have experienced some persistent increase in ex-pump price of petroleum, increasing in the second half by about 12%. Now, often once there's increase in ex-pump price, you're going to have the second round effect. Transportation fares will increase, and once transportation fares increase, it affects almost everything that is transported. Food prices, commodities, and services, and many other things will be affected. So that also affects the inflation basket. And then also pass-through of exchange rate depreciation on the second half of the year. We've also witnessed some steep rise in the exchange rate over the last couple of months, and I'll explain why this is the case. That has also eaten into inflation. I mean, aggravating the already imported inflation. So once you have inflation happening in US, already prices have gone up, and when you come home and your currency depreciates, then it adds on to the prices, or you're going to experience high prices. Other source of inflation has also been food price pressures. We still have supply, chain issues within the food supply sector, and production issues, the issues to do with adverse climate factors, delay in rains and fertilizer supply constraints, the food planting for food and job not being able to get enough money to invest in fertilizers and all of that, and cross-border trade issues, the lockdown of the shutting of borders also affects some products being imported from neighboring countries and all of that. And these actually put pressure on food prices upward. So these are the key drivers of inflation over the last couple of months. So what is the knock-on effect? Once inflation begins to uptick, the policy instrument that will try to anchor expectations about inflation pressures will be the policy rate, because we operate within the framework of inflation targeting, monetary policy. Monetary policy, or the monetary policy rate, is the instrument that is used to anchor inflation, meaning to try to bring inflation back to the normal or the target, the path of medium-term target. And so once inflation begins to rise, the central bank will have no choice than to increase the policy rate in order to anchor inflation pressures. And so you see that as a result of inflation rising, over the last couple of months, the central bank increased the policy rate from 13.5% to 14.3%, from a consistent decline of 25.5% in 2016 to 13.5% by October last year. The banking sector development, we often you hear the central bank saying that the banking sector remains strong, sound, and well capitalized. There is enough data to support that the banking sector still remains quite profitable and reasonably well capitalized. In fact, asset growth has reached 177 billion, increasing by 17.6% from last year's figure. So despite the COVID and all of that, bank continued to expand on the operational assets. Credit growth is expected to continue through 2022. Although the growth has been sluggish, the expectation is that 2022, it is going to recover. The main setback to the banking sector is the exposures, and then the increase, the continual increase in the asset quality. As I mentioned earlier, asset quality has deteriorated from 14.8% in 2022 to 15.2% by December 2021. So that obviously remains a concern, and that also explains why credit growth has been sluggish. Capital adequacy ratio remains very high, 19.6%, from the central bank's target of 10%. So it shows that the banking sector is sound and very well capitalized. Of course, it doesn't cut across. Some banks are still struggling with their capital and their asset quality. External sector and exchange rate development. We've seen some negative impact on the external sector because of some external shocks. Widening in current account deficits. We've seen the current account deficit narrow significantly during the pre-COVID time, but in recent times, we have seen some widening in current account deficits. So it actually is now stand at $2.4 billion US dollars. That is an increase from 2.1 billion 2020. And so that seeing some widening, and widening is unfavorable to the economy because it means that you are paying out more than you are receiving. In that regard, that tend to have negative impact on your balance of payment or on your reserve if the capital account does not offset it. So current account generally has been deficit by trade surplus. We have been recording trade surplus. Since 2017, the country has been recording trade surplus, meaning that our exports have always been higher than our imports, a far cry from what we used to know from our school days up until 2015, when we're always recording negative trade balance. But from 2017, thanks to oil gold production, we have reversed that trend and we've been recording trade surplus. But this appears to be fading away in recent times as the data shows that it's narrowing. That surplus is narrowing, largely because of increases in imports as a result of the economy opening up and the recovery process. Imports have picked up by about 9.7%, much higher than the way export has picked up. So that is narrowing the surplus. The trend has to be reversed, otherwise we will go back to the deficit to worsen our current account deficit situation. Total export earning amounted to 14.7 billion in the year under review and 1.8 higher than the pre-pandemic level. I mean, 1.8 higher from the previous year, but still below the pre-pandemic level. That is our export. So our exports haven't recovered that much to for it to come to the pre-pandemic level or even higher. All exports component increased in the year 2021, with the exception of gold that dropped by 25.2%. And the drop in gold was as a result of drop in gold production. Gold production significantly was affected, I think, because of some of the imposition of small-scale industries. I mean, the moratorium that was placed on them and all of that affected gold production. Crude oil export earnings increased by over 35% on the back of over 50% increase in prices. Because we started the year with low crude oil prices, I think around 45%. By the end of the year, we are around 80 per barrel. And so that really has increased our earnings from crude oil by about 35%. Services and income, we have been observing higher outflows due to higher interest payments on government bonds, some sell-off of government bonds, investors not willing to roll over or reinvest their debts or bonds when they mature, has had some negative impact on income transfer. So transfer private has been on the negative. However, there have been some offsets because we also have been recording very strong private individual remittances over the last couple of months, reaching 3.4 billion in 2021. So remittances has been good. Otherwise, the situation would have been worse. Financing. So the capital account also showed surplus in the year 2021. So financial account were enough to offset the deficit in the current account. Flows coming from the Eurobond that was issued in last year, I think March, by about 3.1 billion. SDR 1 billion, that is from IMF, and then the very significant inflows from foreign direct investment mean that we recorded a surplus of 510 million that went to add to our international reserve. So the overall balance of payments were in excess of 510 million in a year. That helps us to increase the reserves of the central bank. On the exchange markets or exchange rate fronts, we've seen some relative stability, or we saw relative stability of the currency in the first half of the year, but getting to the second half, the country has experienced rapid volatility in the exchange rate market. If you look at the bank rates, the CD depreciated cumulatively by 4.09. This is the central bank rates. If you look at the forex rates, the depreciating on the average is about 7.39%. compared to about 3.9% in the year 2020. That is the dollar. The pound depreciated on the average by 3.11%, compared to last year's depreciation of 7.1%. The only currency that actually appreciated in last year was the euro, appreciating by 3.46%. So on the average, the cedi for last year was 6 cedis to a dollar, compared to, that is, it ended the year at 6 cedi per dollar, compared to 5 cedi 76 pesos in the year 2020. And currently it is reaching very close to 7 cedis per dollar. So what are the factors behind this cedi performance? The main factors are increased forex demand by energy or for energy related payments as they fall due, as well as from the corporate and manufacturing sectors, especially where they have to repatriate dividends and profits that, often at the beginning or at the tail end and the beginning of the year, you see hikes or huge demand for the currency to meet some of these demand. Offshore investors' activities in relation to coupon payment and bond sales, like I mentioned, we've seen some significant sell-off from offshore investors, non-resident investors, those that hold government bonds. That is, if you look at domestic bonds, it constitutes about 16% of government domestic debts. They have concerns, and so they have started selling off the bonds. And once they sell off these bonds, what that means is that they demand the dollar to repatriate or take away the money. And so that's also putting enormous pressure on the currency to depreciate. So, so the key factor or the concerns for this group of investors has been the concerns about Ghana's debt sustainability, and then issues surrounding the budget approval. That is really creating a lot of noise in the financial market against Ghana at the moment, and I'll tell you more. This situation, there's also a situation of the tapering off, that is the US Federal Reserve, the US Central Bank, indicating its readiness to tighten monetary policy in a way to raise the Fed rate. Now, once the US market is always seen as a safe haven, and so once Fed gives that indication that it's going to raise the Fed rate in response to higher inflation, you often will see capital flowing into the US market to hold US bonds or US assets. And so all around the globe, we've seen some significant depreciation of currency, and that is largely due to the capital outflows. Investors moving their money away from these economies to the US economy. So over the last couple of weeks, we've seen a stronger US dollar. The US dollar has strengthened significantly against the euro and then the pound, indicating that there's a huge inflows of capital into the US market. So that is also aggravating our already weaker situation. So depreciating our currency further in the first and last quarter of the year, and of course this month. Now, despite this, we have seen some, the country is well liquid from the perspective of the central bank. Reserves is quite good. Our reserves position as of October stands at 10.8 billion, and that is about 5 months of import cover. And so that means that we have some significant liquidity. But over the last couple of months, because of the huge sell-off, you see there's a drawdown on the reserves, reducing to about 9.6 billion. And if this situation continues, we may see continuous drawdown on the reserves. And that, of course, will not be good for our currency. So the main factors for this decline in the reserves, one of it, or for the outlook of the reserve, if it's not checked, is the de facto closure of the ICM, that's the Eurobond market, the international capital market. As you know, because of the concerns, as I'm going to show you later on, the Ghana no longer has access to the international capital market. That would mean that if you look at the main source of our reserves have come from debt sources. That means government going to the Eurobond to borrow the 3.1 billion, and then from the SDR. Now, that has been the main source. The non-debt sources have been quite slow, quite insignificant over the last couple of years. So if we are not going to have access to international capital market for government to be able to do refinancing of maturing debts, then what it means is that if this debts mature, then government can only come through the central bank or come within the economy to take money to service this debt. And that can significantly lead to a reduction in the reserve. SDR is just about 700 million. A government projection of external borrowing this year is about 1.5 billion. Given that we do not have access to international capital market, the key question is the remaining $800 million. Where is it going to come from? That remains a big issue for government. And then rising imports due to rebound in economic activity mean that we may further see some deterioration in our current account. The deficit may widen, and that could also bring the reserve down. And the energy-related payments, if we should go on like this without any much inflow, then we are also going to see significant reduction in the reserve. Fiscal development, I will not spend too much time here because my colleague Abeku has done justice to that already. So fiscal deficits is projected actually in the year to be, that is year 2021, to end the year by 9.5%. Fitch doubt that. Fitch think that it will be 9.8% in 2021. If you add the energy sector debts and then the financial sector cleanup, that goes to about 12.5% thereabout. It is expected that 2022, the fiscal deficit will narrow to 7.1% and thereabout. So that clearly shows that government need to fiscally consolidate to bring the economy back to pre-COVID era, fiscal deficit of 5% by the year 2024. The key question is whether this is attainable given what is happening around us. So fiscal provisional outcome for deficits now is around 9.7%, higher than the target of 9.4%. And the excess gap was projected loan disbursement related and shortfall in revenue because government has to pay a lot of money in the last quarter for servicing debts that widen the deficit. Investor reaction to 2022 budget has been strong, and that also impacting on debt servicing because the people are not reinvesting their coupons, they are withdrawing their coupons, and they are not rolling over the bond when they mature. Consolidation effort was predominantly revenue driven with uncertainty. Now the market is concerned because they think that the budget is too heavy on revenue. I mean, the fiscal consolidation is too heavy on revenue other than expenditure. You know, for fiscal consolidation, you're often looking at two key pillars. Either you are increasing your revenue to close the gap, or you're reducing your expenditure to close the gap. Now, governments seem to be more optimistic in terms of revenue projection, and so it has projected, as Abeku mentioned, revenue by about 40%, but at the same time, increase expenditure by about 25%. The market is concerned about it. They think that the fiscal consolidation should be expenditure-led, not revenue-led. And so that is also causing some of the noise in the financial markets. The issue about statements or stalemates in passage of the e-levy bill, as Mr. Kwanzaa alluded to, is also heightening concern in the financial market. So that explains why Fitch last 2 weeks or last week came to downgrade Ghana from B to B minus with negative outlook. That really is not well. We don't know what other rating agencies are also going to come up with. Moody's and S&P's, Standard & Poor's, they also come out with their own version. We are not sure. So the market is very uncertain at the moment around what is happening, the stimulus, and so government responded somewhat recently by cutting expenditure by 20% to now give some confidence to the market that, okay, we are now going to try to fiscally consolidate by cutting expenditure, making sure that it is going to be led by expenditure cutting other than revenue, because many of the revenue measures are not quite certain. Government, because of the hung parliament, does not have the political capital to be able to push through many of these revenue measures, or may delay, and that can affect the revenue projection. So consequently, we have witnessed spreads across government sovereign spreads has increased. I'll show you more about that, and that also leading to the closure of the international capital market with implications for financing the budget. That really is a serious problem for the economy. Fiscal policy has responded, like I said, by cutting expenditure by 20%, which is good, sending the right signal to the market. But the key thing, I think, is about the tightness, the rigidity, and the inflexibility in our budget at the moment. Looking at interest payments, looking at compensation, looking at statutory, it gives a very, uncomfortable picture of our economy, of the government's ability to even cut the expenditure that it is talking about, because the three items, compensation, interest payments, and statutory, are all earmarked funds. You cannot really touch it. You cannot cut compensation of employees, or salaries and wages. You cannot touch it. You cannot touch interest payments because that would cause a disaster for you. You cannot touch, statutory. Yes, government can, play around it, but if government have to comply with the law that set up these statutory funds, it cannot touch these funds. And these funds, the three constitute almost 80% of the total expenditure. So essentially what is left is just about 20% where government can play around with the capital expenditure and the goods and services and all of that. So looking at so if you look at our revenue that is coming in, and you look at the tax revenue, that is the tax revenue for the year 2021, of course, the GRA said that they actually exceeded this target to about 57 billion. Now, wages and salary to this tax revenue is about 50%. So it means that more than 50% of this tax revenue goes into wages and salaries. Compensation is about 59%. That is when you add other pension and others to this wages and salary, about 59% of our tax revenue. Interest payments interest payment is about 58%. Now, so this 59 and 58% interest payment and compensation is more than the tax revenue. If you bring in the statutory payments, then the three together constitute about 169% of tax revenue. So to even be able to pay these three key items, tax revenue alone cannot do the trick. And in fact, if you aggregate all the revenues, together and you add these three items, it is 124% of the domestic revenue. So we still even have to borrow from the finance some of these statutory payments. So the question is, how much then will be left to invest in capital, infrastructure, and goods and services, the social protection, and all of the things that government is seeking to do. The cumulative effect has been the widening fiscal deficits, which then means that government has to borrow more and more to be able to finance the deficit. Before the pandemic, government has done quite well by bringing debt sustainability to appreciable level. Debt sustainability in 2019 was around 5.6%. If you add the energy and bailout cost to it, was 61.2%. But COVID-related expenditures and other expenditures, loan it to 76% by 2020, first quarter 2020. By the end of the year, it was around 77%. And now we are talking about 80%, which is crossing the debt distress category. And that remains a concern to the market. The other knock-on effect on this widening debts, which has also increased interest payments significantly. So this graph, I show the effect of higher interest payments on government's ability to invest in infrastructure and to stimulate growth through its expenditure. So you will see that around 2011, 2012, 2019, from 20 up until 2013, interest payments were way below our expenditure in capital, CapEx. From that on, as a result of ever increasing in debt stock, we've seen interest payments increasing and capital expenditure reducing significantly. So interest payment to GDP is around 7.4%, and capital expenditure to GDP has dipped to about 2.9%, and that has a ripple effect, a negative effect on the economy. Now, the noise in the markets, the reason why government has lost its access to the international capital market is because of now the investor saying that they could no longer entertain the uncertainty in passing the budget, and then the mounting debts, a situation which may compromise government's ability to repay the debts or interest payments when they are due. And so the market is now increasing their risk premium. So the spread, what we call the spread. So to put it in context, if you remember 2-3 years ago when government went to the market to issue a 26-year Eurobond, the interest rate on that Eurobond was 8.8%, right? And that's a 26-year Eurobond. Now, once that Eurobond is issued and the coupon rate is 8.6%, the bond goes into the secondary market for trading. Now, the trading, depending on what is happening in the country, the issuers market, the investor will demand certain interest rates. Okay. Now, the interest rate on this bond has increased, by about 1,000 basis points, according to Bloomberg, to the extent that this 8.8 is now being priced around 14%, 13 to 14%. So what that means is that if government should go to the markets now, say that because some of these bonds are maturing, so government wants to go to the market to borrow to refinance this maturing debt or to close its fiscal deficit, the same bond with the same term to maturity will be priced at 14%, which is outrageous. No, in the international market, no one will be able to endure that. And so you will not even want to go. That is what it means that the market has closed its doors to you, So you cannot go and be punished like that. And in fact, people will not even want to buy because the price has fallen so low. The value of the bond has fallen so low. So that is what is happening. So you can see the uptick from September 2021 to November, seeing that increasingly the risk premium or the sovereign spread on government bonds have been increasing, and that's culminating in the shutting of the ICM, International Capital Market, to Ghana government. However, it is not all that gloomy. The move by government to cut expenditure in just last week and others have seen some stability in the market, and also the fact that our economic growth remains robust, very robust, gives some confidence to the market, and also reassures the market that the economy is on the path of recovery, and government is very much committed to expenditure containment and consolidation. So Ghana GDP growth has consistently outperformed the Sub-Saharan Africa regional average, as we saw a growth of 6.2% in 2018 against 3.7% in South Africa, in Sub-Saharan Africa, and even in the COVID era when African countries' growth contracted by 3.3% on average, Ghana's growth was positive. And so on the whole, growth projection looks very encouraging. These are underpinned by government policies that is looking to expand the productive base of the economy, is looking to provide employment to the youth. So programs like Ghana Cares of AmCham program, the Youth Start program, the 1G, 1F, and the attraction of industry by some automobiles, the stable power supply that we are currently enjoying, the bailout of financial institutions, the cleanup that has brought some sanity, and that is expected to increase credit, the establishment of key institutions like the Development Bank, which is yet to be launched, the National Home Ownership Program, International Financial Service Center, and a host of others like the AFTA, and all of that are promising initiatives that, if well implemented, as Mr. Abeku mentioned, will be the driving force to expand the productive base and to significantly lead to our debt to GDP ratios coming down and our fiscal deficit coming down, and to bring the economy back to the path of sustainability and inclusive growth. So thank you very much for your attention, and I'll stand by if you have any questions. Thank you.
Thank you. Thank you, Professor Eric Osei-Sibe, for this great and excellent presentation. We do reckon that we've taken much of your time, but we have some questions. But before we go to the questions, this is just a quick announcement from the chamber. On the 3rd of February, next week, Thursday, we are meeting here at 2 p.m. So those of you on the digital committee, we are meeting at the chamber secretariat to discuss the e-levy. So kindly take note of that invitation as well. And also, most importantly, Monday would be Survey Monday. We are sending out once again the questionnaires for the impact of U.S. investment in Ghana. This is a West Africa-wide research being conducted with AmCham, Nigeria, Senegal, Cote d'Ivoire, Ghana. So please watch out for that in your email addresses. And lastly, we have sent out invitations as well for those of you who want to host cocktail receptions here. You are most welcome to our facility. So thank you very much. Prof, I have a question here, and the question has to do with how to build or sustain investor confidence, given government's increased need for borrowing in 2022. It appears that there's some decline in investor confidence in Ghana, especially because government has been unable to recover from past debt. Do you have any idea how we can build and sustain investor confidence? Over to you, Prof.
Thank you very much, Simon. That's a multi-dollar question. There's no easy answers to it, but I think that the key thing to build investor confidence is government demonstration of fiscal consolidation. That is government ability to raise the targeted revenue. That will indicate that government is ready to, bring the debt level to a sustainable position. So government has to demonstrate that, and that we'll want to see that in the next few weeks, the e-levy should be passed, the benchmark import duty should be restored, that is the reversal of it should come back, and then government should demonstrate expenditure control, significant expenditure control in the next couple of months. That will send some signal to the market that government is ready to, safeguard its fiscal position, is ready to save money to pay interest on loans and others. On the real side, there's no question about that there's some momentum in expansion of the economy, given some of the policies that government has rolled out, but most of it will be contingent on government ability to raise revenue to invest, especially with the U-Start and then the Obatampa and all of that. Would require some significant, investments from government. But the main thing, if I could, answer your question, will be for government to demonstrate its commitment to fiscal consolidation, meaning that cutting expenditure significantly, especially from the social spending that weighs so heavily on government, and then also making sure that it's able to push through its revenue measures that would give some comfort to the market.
Great, thank you. So let me move over to Abeko. There's a question here as to what will be some of the practical strategies that businesses can put in place to mitigate the impact of the tax provisions in the 2022 budget. Over to you, Abeko, if you're with us.
All right, so so thank you very much. One of the recent trends we tend to see, especially from GRA's audits, is to attempt to reconcile tax accounts, and I explain that very soon, and the financial statements. And to the extent that there is a gap, that unexplained gap is treated as revenue or taxes that has not been paid. So for example, I enter into a business relationship with AmCham to provide tax services to AmCham in 2022. If I raise my invoice in 2021, the VAT law requires that I should account for that VAT on condition that I have raised a VAT invoice to you. It doesn't matter whether you've paid or not. But the financial accounting rules only require me to begin recognizing revenue when I start working for you in 2022. So if the revenue comes to now audit in 2021, they would pick your VAT return or your VAT account and seek to reconcile it to your financial statement. And mind you, audits don't take place as close as this. Audits could take place about 5 to 6 years after those transactions were done. Now, when they do the reconciliation and you cannot remember that, oh, this invoice was raised to AmCham in 2021, but I performed service in 2022, GRA would then say that what you disclose in your financial statement was a downstating of your revenue. So it means that you have shortchanged the state, so pay additional taxes on the disclosures for 2021. So in brief, what I would recommend as a practical way is that going into this year 2022, businesses should develop the culture of creating what I would call tax reconciliation statement. We already do that for current taxes and deferred taxes, but we don't tend to do that much for other tax handles. For example, VAT to financial statement, withholding tax to financial statement, withholding VAT to financial statement, PAYE to financial statement. We don't tend to do that. So to end, I would say that when you prepare your financial statement, even though what you disclose as cash and bank, or cash at bank and cash that you have at hand, you may do your disclosures on the basis of your cash book, but you still do a bank reconciliation statement to understand why there is a gap between your financial statement and what your cash records are showing. And you keep that on file to explain to anybody that even though my account at Barclays says that I have 20 cedis, in my records, I have 30 cedis because there was a check that I received from Simon, but it's not gone through yet. So in brief, let us develop a culture going into 2022 that whenever we engage in transactions, we try to reconcile the tax effect to the financial statement. If possible, keep an annual recon, or if you can do it better, monthly or quarterly recon to save you from the challenges that may arise when the 2022 period is audited somewhere in 2027 or even 2028. Thank you, Simon.
All right, thank you very much, Abeku. I think that I would just throw in the one last question, then you and Prof can answer that, and I will call it a day. So with all the things that we've heard and with what we've been, spoken to about this morning and the data provided, if a business is interested in, expanding or doing business in Ghana, with a tax burden available, with micro and economic fundamentals being a bit shaky now, what would be your recommendation? I'll hand it over to you, Abeku, and to Prof, and then we'll end here.
Okay, Simon, if I'm on this call with Prof, it's obvious that I need to let Prof take the lead.
Take the first one, okay. So Prof, it's over to you, sir. I think Prof is muted.
Oh,
yes,
okay,
Prof.
thank you.
Okay.
Right. So let me attempt it. It's a difficult question, but let me attempt it. I think there is still enormous opportunities for businesses to invest in Ghana because returns in Ghana still remains very high. That is returns on investments in Ghana remains very high. We still have very conducive, quite conducive business environment in relative terms within the sub-region compared in ourselves to Nigeria and other places. We have a much friendlier business environment and then more supportive regulatory environment for businesses to thrive. We are more like a hub, with the focus of investments. In fact, FDI performance has been one of the best, compared to our African countries. FDI inflows to Ghana is actually leading in compared to many African countries today. And so the opportunities are available here. Government, fiscal position notwithstanding, I still believe that, investors are likely to make some good returns with the AFTA program, the rollout of the AFTA, and the implementation of it definitely will be a game changer. The payment system that was recently launched, the SPARTS payment system, that the Pan-African payment system that was recently launched. Government is just, I think, in the next few weeks or months, launched the Development Bank of Ghana, that's the GPG, that also coming to fill in the gap. I mean, the declining credit and all the others, they are coming in to provide, medium to long-term credits to businesses with, some competitive rates. And so I will say that regardless of the uncertainty, which I believe that it will die down in no time, because I may know well cool, given what is happening in other countries with the Omicron spread and the geopolitical tensions across and climate change in many countries. There are uncertainties and risk, everywhere. And therefore, I think comparatively, if government is able to go over this in the first quarter, of the year, the noise will die down. And with the peace and stability that we enjoy and the friendly business environment, I'm sure that businesses will start doing well, and there's more room for profitable and lucrative business opportunities to spring up. So, I hope I've answered your question.
Yes, you have. You have perfectly, Prof. And thank you for that. All right, Abeku, would you want to give us your last words before we close?
All right, so thank you very much, Simon. I have nothing else to add to what Prof has said. We just encourage our businesses here that so long as you try as much as possible to appreciate and get support for all the initiatives that government is introducing, you can actually navigate the water. So as Prof said, average returns in Ghana on businesses is still quite attractive. So the question is, why are others able to navigate? It is because a lot of them seek support. So seek support, and I'm sure that you would get the support to run that profitable business that you seek to run in Ghana. Thank you very much.
All right, thank you very much. So seek support and you'll get the needed support to run your business. This has been AmCham's Economic Outlook for 2022. Thank you for joining us, and we will see you at the next webinar or in-person event. So thank you to our distinguished speakers, Abeku Jankwansa from Pricewaterhouse and Professor Eric Osesibe from the University of Ghana School of Economics and also International Programs Office. Thank you, cherished listeners, for joining us, and we'll see you at the next one. Thank you very much. Good morning.
Thank you.
Thank you.
Bye-bye.
Yes, bye to everyone. Bye.
Bye. Bye, Simon. Bye.